Welcome everybody to the Real Dealz podcast, one of the top-ranked real estate investing podcasts for the last 7 years. This is the place to be for investing strategies you can actually use, expert interviews, and of course, some good old-fashioned entertainment. Now, here's your host for the show, Elliot, the REI guy, Smith.
What's going on, Real Dealz podcast listeners? I am here with a new weekly show. So, summer is finally in full swing. Excited about that. Apologize for not having a couple episodes out, but we have been doing some traveling, some family vacation, and just enjoying finally having some sunshine. It was a weird year here. They had what was called an atmospheric river. So it's supposed to be nice here in April, and it rained April and all of May, basically. So, couldn't do much, so we've been taking advantage of the nice weather and doing family things. So, lots going on in the markets and a lot of headlines to go ahead and talk about. Crazy stuff. Everybody is saying the market's crashing. Oh my gosh, it's going to be worse than 2007. And I am going to go over just some of the research tools that I use and just some thoughts that I have to put this in perspective a little bit. So, and just preface this with, I wasn't a real estate investor in 2007, 8, 9, 10. I was an investor in 2015 is when we started. So I'm excited for this because now I get to see if I'm as smart as I think I am. Now, if you've been listening to the show for a while, I feel like I have some very strong opinions, but I also do a lot of research and spend a ton of time to study where that opinions come from. So I have bets on this market with a few buddies, a couple that I wish I wouldn't have done and a couple that I feel pretty good about. But mine are all bet to the upside, that I think housing will be okay. Similarly to April of 2020, when COVID first hit, a lot of people, including myself, hit the brakes. We thought, oh my gosh, the world's gonna end, real estate's gonna crash, what are we gonna do? I hit the brakes. I had a few buddies that hit the gas, and they look very, very good right now, and I really wish I would have done the same. So right now, the Black Swan event that everybody's calling for, which a Black Swan event is something that people don't envision that takes down a market, right? So everybody says, here's why they say the market's not going to crash. One, well, it crashed because of bad mortgages, and we had no bad mortgages last time. Okay, that's one. They also say there's no inventory. Builders didn't build, blah, blah, blah. There's no inventory. That's what people are saying that's not going to crash. Those are the main reasons, right? Well, there's also alternating viewpoints to that as well. There's also what they call shadow inventory. And there's also a lot of second homes that people might have bought in Florida, Arizona, sunshine states, and they still have the first home. What is the first thing to go if people start getting laid off? Second homes. The other thing, and I said this a couple weeks ago, don't be worried. There's no bankruptcies or mass layoffs that are happening. We're fine until that happens. Well, the next week, what was it? Compass, they shut down their title company plant. There was a lot of talk about layoffs. The tech sector just got crushed on the stock market. So that was okay, well, crap. That argument doesn't hold as much water, but there's still not a lot of things going bankrupt. The one you'll see a lot of things happening is people will start to tighten their belt. They'll freeze hiring, which you're hearing a lot in the headlines. They will they'll cut costs on, exploratory things, just like Amazon is cutting costs on putting their warehouse space and all these other things that they were trying to do to grow. They'll start cutting and tightening the belt on those things first before they start to lay people off. But that doesn't mean they're laying people off. That means they're just bracing themselves for a little bit lower cash flow situation. You also might have read articles on CNBC that speak to, if you're a tech founder, a startup that's backed by venture capital, don't expect to raise money in the next 2 years. The money spigot is basically being turned off for cheap capital, especially now with the Fed raising rates to 0.75 on the last meeting. the market had baked in a 50-point basis rate hike. We got 75 basis rate hike. And for the next month, they're going to do 75 as well, minimum. So the market basically baked in 3% or 300 basis points in rate hikes throughout the end of the year, and now it's getting revised to 3.5%. That is what caused the market to go down significantly after last Wednesday. So the market anticipates the Fed doing something, and they bake that into their formula. So if you're ever listening to financial news, that's where they say this analyst has a 75% percentage chance of this baked in, this happening. And when things are in the 25% range, the markets react poorly. When they stay in the 75% range, they react whatever based on the news for that day. So this is going to be a lot of this stuff. I think this is the most important thing you can do as a real estate investor. This is why Tucker has been so successful. He knows his numbers forwards, frontwards, and backwards. This is why, if you listen to his new show, he was able to find lots under value in the best neighborhoods of Naples the first month he moved there, because he studied, he figured out where the best neighborhoods were, and he had a lot of things going. He did a lot of research into that market to understand what the market was like. Most people, if you're just doing a wholesaling business, you're in a sales and marketing. That's what you're doing. You're doing sales and marketing. You are not a real estate investor at that point. If you're just doing a fix and flip business, you are still more so in a sales and marketing business, because you market to buy a house, then you have inventory, then you put money into this to increase the value, and then you sell your inventory. That's more investing, but still a little bit less than building houses or taking risks on area, buying dirt, doing development, buying rentals, buying value add rentals in certain areas that are going to gentrify. That's investing. Good investors research and understand what they're investing in, and they do a lot of work. That's why Wall Street has so many people that are paid so much money that are called analysts. That's why they have them. That's why they have jobs, basically. So how do we become an analyst in our market, and how do we decipher the numbers to give ourselves the best chance of making the best decision moving forward? Now, is it going to be 100% right all the time? No. But just like they're baking in on the stock market, the 75% and the 25% things we talked about, you are going to try to do the same. You are trying to bake in that I have a 75% chance believe in this is going to happen, but then you need to figure out how you protect yourself if the 25% stuff is what actually happens, it comes to fruition. So let's get into it after this quick word.
All right, Real Deals podcast listeners, I want to talk quickly about our show's sponsor, Ironbridge Lending. If you guys have not reached out to Ironbridge already to talk to them about funding some of your upcoming flip projects, I highly encourage you to do so. I've known the owner of Ironbridge for a very long time. I personally borrowed millions of dollars from them over the years to do a number of different projects, and I can say without a doubt, they are the best hard money lending company I have ever come across, and that is the reason why they are the sole sponsor of this show. I've had a lot of other companies reach out to me and want to sponsor this show, but I just won't do it. I feel like I need to be genuine in who we have sponsoring the show, and it needs to be somebody that I've personally done a ton of business with. So I personally vouch for their ability to be the best, hands down, in the world of hard money lending. You won't find better programs, you won't find better terms, and they're lending or will be lending in over 20 states. So chances are, if you're hearing this in whatever state you're in, it's definitely worth it to check out their website, reach out to them, see if they're lending in your state, and if they are, I would absolutely encourage you to do business with them. Another very cool thing to note is that they have a program for most rehabs where you can actually borrow up to 90% of the purchase price. Now, this is given the fact that you are actually buying a deal, which if you're listening to the show, that means you probably are. But if you have an actual deal on the table, they'll fund up to 90% of your purchase price, and they'll even give you rehab funds on top of that, which means that it only takes 10% down to get into a project, which is unbelievable in the hard money world. So do yourself a favor, reach out to Ironbridge Lending, have a conversation with them, see if they're a good fit for you and for your next project. I can guarantee you that you'll be happy that you did.
So we're going to get back into it. There is a lot of stuff to get free information out in your markets, and I picked 8 markets to kind of go over in this. Now, you might do well by seeing this on video. We'll have it on YouTube, but also you do not need to watch it as well. I will make sure that I'm very verbal of what I'm looking at and things like that. So let's go here, and I'm going to go to my screen share. And so we can start to see everything here. So we'll go screen share. Let's just go screen total. Okay, share, and that goes up there. All right. First off, the company that I like to read every month a lot is Black Knight. Black Knight is a data company, and they're used a lot for mortgages. And so they have a lot of good blogs that I think are really, really good, and you can get a lot of information of what the market's actually doing in real time for the most part. So, but they're more on the mortgage data side, and so you really want to look for, on the mortgage side, you want to look back to see what's going to happen, but you also want to look at trends. And a couple of things we need to look at right now is, one, construction and inventory. How much do we have? Total equity in the rate of home ownership. So people that own their homes, what are their equity? What is their interest payment at? And how much are delinquencies and forbearances going on right now? How much of that stuff is happening, right? So this is going to be something that I think you should read every month and be going to them. So it's just Black Knight mortgage data is basically what it is. So there's a couple articles that I've been reading and paying attention to, and there's the first one is going to be, it's called Trending Towards Zero. And so this one stood out, Changing Home Sales Dynamics in a Low Inventory Market. And so this is a white paper basically that they wrote, and they're saying that we're running out of houses still. We still don't have enough houses. That's why it said Trending Towards Zero. So it's basically going through a lot of numbers of sales, absorption rate, active listings, and I have some numbers to go over these as well, but it breaks it into every market of where they think these are going to have the most issues, right? Where they think we still won't have enough houses. So if you, back to economics class, which I didn't take, but basically you have what's called supply and demand. So currently we are in a low supply, high demand environment. Mortgage rates, as low as they were, just drove demand. The pandemic drove demand to Sunbelt markets, more red states, or getting out of these lockdown states. Again, I don't care which side you're on, it's just what happened. So the supply and demand was way off kilter. 2008 to 2012, the supply was way off kilter and the demand was really low because people did not like real estate. Real estate's kind of what crypto has been as well. It's the hot girl at dance. You see people making a lot of money, and just like us, you say, how we got into it, you're like, this guy's making all this money flipping houses or owning rentals or whatever. Look how easy it is. I want to do that as well. Now, it's a lot harder than people say, but that's what gets people in. So as soon as you start reading all these headlines that say, inventory's doubling, sales are down 20% month over month, year over year, all these just catastrophic headlines, all of a sudden real estate is not the hot girl at dance anymore, right? Now all of a sudden it's bad, bad, bad. But as a real estate investor, we want to dive into the numbers to see if that's really true. All news is driven fear-based news. Everything is driven that way, whether it's politics, health, investing, Bitcoin, all those things. That's how they drive ratings. They bank on your fears. So this goes through basically the single family housing inventory and basically shows that we literally don't have hardly, that's months of inventory. We have very minimal inventory. And what I've been looking at for myself is when I'm diving in like Vancouver and my market is what was it like before the pandemic? Because the pandemic since March of 2020, let's say June of 2020 till January this year or now, that was the anomaly. That was the black swan that nobody saw happening, right? The anomaly was the market went crazy and went nuts. Now, if I believe, which I do, that we revert back to pre-pandemic inventory levels type of market, where does that take us? So if you look back from, let's say, 2014 to 2019, where was your market at? That's what I consider probably more of a normal market, and what we've been in is an anomaly market. That's the black swan. I think it's going to go back more to those years, and that's kind of where the market should stay at. And why I don't think the market's going to depress a ton is because housing prices rose so much that even if you were to lose 20 or 30% value, which would be more than the Great Recession across the whole market, then you still go back to 2021, mid 2021 price points. And we'll get into that a little bit more. So this article is very good. It shows all these things, reasons of why they think that we are actually in an environment that is going back to zero. Okay. Another article that I've got and I found it online. The University of Washington here in Washington State, they have a Washington Center for Real Estate Research built by the college. I would assume that in most states, you will be able to find this data. I really like this because it dives into just Washington State and it's done very, very well. So they have some highlights here, but they also have numbers broken down by county. And it has it from, construction, new construction starts. Now that's a lagging because it's hard to get that data. But they also have multifamily starts, housing affordability, all the different things that are pertinent to what we're looking at. So, and it breaks it down also by county in our state. So this was a very good article, and that's a good place to look for it. Look at your colleges and just try to find research papers. Okay. Next one. So that's Black Knight. The next one that I think is a fantastic place to look for stuff, and I use this and I go over this every month, multiple times a month, is Redfin Data Center. They have very integrated graphs and charts that is coming directly from the RMLS, which is the multiple listing service. So they have basically every region, every state, every city except my home, Tri-Cities, because they haven't given approval to Redfin for whatever reason. But any place that Redfin's at, they have their information here. So you can go in here and you can find out, download all the data, which I do frequently, and I put it in my own graphs and spreadsheets. Sales prices, home sales, new listings, inventory, pending sales, active listings, sale to list ratio, price drops, off market within 2 weeks, sold above list, all these different things. And you can go all the way back to 2012. They also on this page have Redfin monthly rental market data, which you can basically go into certain markets and you can see if it's cheaper or more expensive to either buy a house or rent a house. So that's the great argument. Do you rent or do you buy? Right now, it's probably getting very close to being cheaper to rent in most markets. They also have on here, they'll have different places that you can go to. They have migration. So you can look on this as well for migration and just plug in a ton of cities and see where people are going, where the inflow and outflow is going. And if your city is actually down people or positive people. So you'll see how much people are moving in over the last so many months or whatever. So they also have the staying chart, how many people are staying. And that's all, a lot of that is looked at by the Redfin users looking at if they're in a market, what market are they looking at? Are they looking at buying houses in their own market or another market? So it's very good data. They have historical flow, all those things. Then they have new construction and they have investor data. So they go through here. Are investors still buying? So national investor share of the market, they say Q1 is 20% overall share. That was on the bought market. So investor purchases, home sales, blah, blah, blah. And then you can go different things, investor purchases, year over year growth. And then you can dive down into a handful of 20 or 30 markets, main markets. So that's super helpful because the headlines have read a lot lately as well. Investors, Wall Street's buying all the houses, which I think is, I can talk to that in a minute, but I think that is something that is happening. Actually, I can talk to it now. Blackstone and State Street, if you go to Yahoo and you see what companies they have ownership in, they own basically every major company you can think of. They have very similar stakes in Pepsi as they would in Coca-Cola. So why does that matter? Well, if the food industry has been consolidated to a few companies, and the agriculture has been consolidated into a few companies like Monsanto or the beef people that create, do the beef or poultry, then they essentially control the food supply. Energy, they basically control the energy supply because they have people on the boards and they have a high stake in these companies that run these sectors. And so they have a say. So a lot of this stuff is by them. Now, if they have energy, they have food, what else are they missing? They're missing housing. So Doesn't it make sense if you wanted to control everything that people need? Wouldn't you want to consolidate those things, right? Because they also have media as well. And it doesn't matter which side you think they're going for. It doesn't matter on that, other than it is what it is. So I think they're going for housing. We've talked to a couple of these hedge funds, and what they basically told us was, if you want to own and have an opportunity to invest in real estate and enjoy the appreciation, don't buy the house, buy our stock, because they want to turn the housing market into a renter's market. So, but you can see these things, and then you can also see new construction, price points, listings, inventory, starts, things like that. So these are very helpful tools to look at. Also, you can look at market competitiveness, job opportunity, and then you can print all this stuff off. It's very helpful if you're trying to find investors right now as well, because you can print off market data to support whatever deal you're looking to do. So next, let's look at mortgage rates. So if we look at mortgage rates, most of us have been enjoying this mortgage market at very low rates that we've never seen before, right? So rates have gone up a lot this year. Yes, that has been, for sure. So they've gone up this year from January basically to 30-year fixed Freddie Mac loan, 3.22% to this June 23rd, 5.81%. Now, other places might be a little bit more, maybe a little less. This is what it is on Freddie Mac. So looking at that. But if you look at rates from 1970 to 1990, where inflation at the top point was pretty high. I apologize, I don't know off the top of my head. You can find that data off of the Federal Reserve. And so I go look at the federal housing data for the Federal Reserve market. Mortgage rates from 1970 to 1990 were at the low 7.75%, and at the high, which was in 80 and 81, 18 and then 3/4%, right? The housing market, due to high inflation, median price was like $26,500, and it ran all the way up to $128,500, something like that, from 1970 to 1990. So in an inflationary environment, you have a physical asset. It's going to cost more every day to build that house, for lumber, for gas, for labor, all these things. So in that 20-year time frame, the market still rose from 26,000 to 128,000. So will there be some tough times to sell things? Yes. Is it harder on a fix and flip market level? Yes. Is it harder on a new construction level? Absolutely, because you don't know where pricing is going to be. But let me show you why I think where I am pricing my flips. We just closed on one today. So go over here to Excel, and this was all data that I pulled just today from Redfin. So the median house price from January of this year to May of this year, and the reason I did that was because it went up astronomically, right? Because everybody had these low interest rates. They were trying to buy a house while they were locked in with low interest rates. So Seattle went up 21%, almost 22%. Vancouver, one of our markets, went up 10.25%. Spokane, 20%. Boise was up 18%. Phoenix was up 10.5%. Dallas was up 33.5%. And this is median house price from January of 2022 to May of 2022. That is basically like 8%, 7% a month, right? Jacksonville was up 18% and Tampa was up 12.5%. So if we do this as an average level, right? And the market, we think the most the market can top out is 25 to 30% across the board on a negative, decreased level, because that would be huge. Well, that only, for most markets, that takes us back to January of this year pricing, or maybe August of last year pricing, but we still have a long way to go before we start hitting most of the people. So what that means in my mind is there is record number of equity in houses right now. Majority of people that have a mortgage a lot of the people have a mortgage that's below 4%, also below 5%. So unless they have a reason to go buy a new house, why would they ever sell? We still have a lack of inventory problem, and new construction was hit by the supply chain. So that saved our butt right there. So we don't have a ton of inventory. So even if the market was to crash like it did in 2008 to 2012, right? Crash. We still don't go back all the way till, pricing. So we don't touch most people and go negative into their equity they have. Most people still have equity. What happened last time is people didn't have any equity, so they were upside down on their house, so they started getting foreclosed on. So if you still have equity in your house, and there's still some people that want to buy a house, one, you can sell it, because why would you just let it go back to the bank if you still have a decent amount of room from the mortgage to what it's worth? So there shouldn't be a flood of people flooding the market with inventory here is what I'm saying. So now people are saying also on these headlines, inventory's up 20% month over month, blah, 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 all this shit, right? If you look at it, so from January to May of this year, the inventory, yes, in Seattle has risen, and I'll go through each one, 109%. So gone up 109%. So Vancouver, 99%. This is inventory, right? So it's basically doubled. Spokane, 256%. So I'm sorry, 156%. So it's more than doubled. So my numbers start with a 2 in front of them. So we'll start that again. So Seattle's up 209, Vancouver's 199, Spokane's 256%, Boise's up 340%, Phoenix is up 139%, Dallas is not much, 110%, Jacksonville 106, which is minimal, and Tampa is up 131%. Now, let's take that number and say May's inventory to May 19 inventory. Where was that at? Because that was a very good market. People still made a lot of money, right? The market still seemed like it was, selling quickly and you're getting multiple offers on houses. This is my argument to most of the negative news to say I think we're just going back to where we were at in 2017 through 2019. So May of 2019, the inventory in Seattle was 2,085. May of 2022 was 895. So it was 233% more in May of 19 than it is still today. Vancouver, 233%. Spokane, 227%. Boise, 111%. Phoenix, 180%. Dallas, 329%. Jacksonville, 213%. And Tampa, 252%. So looking at these numbers, it's a huge difference, right? So that there was way more inventory in 2019 than there was even today. And the market was still good and people were making money and people were still interested in investing in real estate. Let's now look at month supply of inventory. So they have that as a number. So if I have no more houses go on the market, how many months would it take me to sell that supply, right? So that's what they consider, that's what they consider this number. And usually what a neutral market is, it's a 6-month inventory. That's where it's not really a buyer's market, not really a seller's market. Now, some markets might be 4 months, some markets might be higher, whatever. Let's just say 6 months is probably the average. Right now, and this is why I will disagree with people saying that, hey, this is going to be a buyer's market really soon. Yes, certain opportunities, you will have more chances to get a better deal on the market or whatever, sure. However, it's still going to be hard because there's still not enough inventory, right? So in Seattle, it went in May of 2022, it was 0.8 months of inventory versus 1.9 months in May of 2019. So first number I'm going to give you is 2022, and second number is going to be May 2019. So Vancouver, 0.7 to 1.7. Spokane was 0.8 to 1.6. Boise is 1.6. So more inventory now in Boise than there was. It's 1.6 to 1.2. So Boise actually has more, has more inventory now than they did in May of 2019. So Boise's a red flag. Phoenix, 1.5 to 2 months. Dallas, 1.1 to 3.4. So literally, they had 3.4% of months of inventory in May of 2019. They're only at 1.1. I know a lot of people that made a lot of money in Dallas in 2019. Jacksonville, 1.1 to 2.4. and Tampa 1 to 2.1. So the sky is not falling, at least for right now. Now, I may come back to bite myself with this podcast. However, right now, it's not falling. Now, if you go to mortgage, or you go to foreclosure starts, there was a very good article on the Black Knight deal that went into, and it was actually that one I brought up earlier, and I will bring that back up. They started talking about mortgages and where the foreclosures are in comparison to before. So let's see, top single family markets, let's go. And price growth, up and away. So they're saying there's a lot, I don't have it exactly right here, but dive into these articles. I can send them out to you if you ask for them. But basically, there is not a ton of inventory. Everybody has equity in their property. If people have equity in their property, the market does not go back and get depressed. The reason we had such a crash in 2008 to 2012 is people were taking mortgages out that they couldn't afford. Builders were building way more homes than they should. We all of a sudden had an inventory problem, and the supply well outpaced the demand. So people got foreclosed on because they went negative in their equity position and they couldn't make the payments. Right now, we still have so much equity because of the last 2 years of run up before we ever get to somebody that has negative position in their property. The people that might have a negative equity position are somebody that maybe has bought from right now all the way to, say, December of last year, or in some markets, maybe February last year. So that'd be, 14, 15 months ago. But if you look at how many homes were sold in that time frame, there's not that many comparatively to how many homes are on the market. So even if those were all to go to foreclosure at the same time, which would never happen, you still would not flood the market into a buyer's market. So this is the time to be patient. This is the time to look and learn your market, but I also think this is the time to push the gas. If you're an agent, push the gas, build your team, take market share. There's going to be a lot of people that drop off that were let's say the hobbyist agents, the hobbyist investors, or people that just were annoying, right? They were taking 1 or 2 deals from people, right? There was a lot of people like that. That group of people is going to go away. So now all of a sudden those 1 to 2 deals are going to open up. Who's going to take them? The people that really invest in themselves, to understand their market, invest in their team, build a team, and push the pedal to the metal. Now, I say that with also be very conservative with your finances. Make sure you have runway. Make sure you have money in the bank. Make sure you have 6, 9, 12 months. Make sure you are pricing your flips accordingly. We are now pricing our flips to what we think it's going to sell for comparative to our last one we just closed on today. We priced it to January pricing of this year. So not what it just sold last week, but January pricing. As we continue to go, we're going to price them a little bit less and less. So you're now you're catching a falling knife basically. So be conservative on where you're pricing them. Market is going to punish also houses that aren't looking very good. So a lot of people have got away with having a really nice house in the wrong neighborhood, on the wrong side of the street. They're going to punish people that have not done the best rehab, that sloppy rehabs. They're going to punish terrible design choices. They're going to punish functional obsolescence in houses that don't work. They're going to punish you if you're not really, really good. So make sure you are honing your skills. Make sure you're doing a good job. Make sure you're buying houses in the right place, and then price accordingly. Also, on your rehab side, you need to price that with inflation in mind. So basically, you're going to price your rehab higher. I'm guessing if it's a short rehab, we're pricing it 10% more. And we're basically pricing our end sales price 15% less than right now. And then if it goes longer for a longer rehab, we're pricing it 15% more in expenses on our rehab. So make sure you're taking those into consideration. When you're negotiating with sellers, use this to your advantage. Say, look, I'm taking all the risk here. We're in a terrible spot in the market. You can go list it with an agent, no problem. But just know if they're wrong, your pricing is going down every week if this mortgage market keeps changing and inventory keeps going up. If you sell to me, I'm taking all that risk. That's why I'm baking this price in. So just be like you don't need them, and I guarantee you'll buy more deals. I just retraded the neighbor next door, and I don't usually retrade, but I went from that position of I don't need to buy this, and he took it instantly. I was at 275 first. 2 days later, he got back to me. I was at 265 that day, and he took it. So I think what I'm saying here is you need to study your market and become a real estate investor and be a student of the game. Everybody I know that is very successful does these things. Zoning code is also important, but study the numbers and make your own opinion. Don't listen to the headlines. All right, have a great day, guys.